If you understand what the Fed actually does, the next question is obvious. What is it trying to do all of that for? Why raise rates at one point and cut them at another? Why sound aggressive in one year and cautious in the next? The answer starts with the Fed's dual mandate. The Fed has two main goals: maximum employment and stable prices. In simple terms, that means it wants as many people working as possible, while also keeping inflation under control. Not too hot, not too cold. That is the balance the Fed is constantly trying to manage. Maximum employment does not mean every single person has a job. It means the labor market is strong enough that most people who want work can find it, without the economy overheating in an unsustainable way. A healthy job market supports spending, confidence, and growth. Stable prices means inflation stays low and predictable. Because when prices rise too fast, money loses purchasing power. Households get squeezed, businesses struggle to plan, and the economy becomes unstable. Inflation is not just a number on a screen. It changes how people live. The problem is that these two goals can conflict with each other. A strong economy with booming demand can push hiring higher, but it can also push inflation up. A weaker economy can reduce inflation, but it can also cause unemployment to rise. This is the tension at the heart of Fed policy. That is why the Fed is always balancing. If inflation is too high, it may raise rates to slow demand, even if that risks hurting jobs. If unemployment is rising and inflation is under control, it may cut rates to support growth. It is constantly choosing which side of the mandate needs more attention. This is also why markets obsess over economic data. CPI matters because it tells traders something about inflation. Jobs reports matter because they tell traders something about employment. Wage growth matters because it can affect both. Every major report becomes a clue about how the Fed may react. And once markets think they understand which side of the mandate the Fed cares about most, they start repricing everything. If the Fed looks more worried about inflation, markets may brace for tighter policy. If it looks more worried about growth or jobs, markets may begin pricing in cuts and easier conditions. This is where people often get confused. They think the Fed is reacting to markets. Sometimes it is. But more often, markets are reacting to the Fed's reaction function. They are trying to predict what the Fed will care about next based on the dual mandate. So the dual mandate is not just a boring policy phrase. It is the framework behind rate hikes, rate cuts, bond yields, stock valuations, and even crypto price swings. Once you understand the mandate, you stop seeing economic reports as isolated headlines and start seeing the chain reaction underneath. But there is one part of this framework that markets care about more than almost anything else: interest rates. Because once the Fed decides which side of the mandate needs attention, interest rates become one of its main tools to respond. That is why the next video matters so much. Because if you really want to understand how Fed policy hits the real world, you need to understand why interest rates move markets. In the next video, we break down exactly that.